That's supposed to happen once every 4.1 million years. It happened a couple months ago.
When markets swing and headlines fuel fear, it's easy to lose sight of what really matters. Not just growing your wealth, but protecting your joy. What if you could tune out the noise and focus on the signals that truly matter? Today, I'm joined once again by Ryan Detrick, Chief Market Strategist at Carson Group, CNBC contributor, and two-time Business Insider, Oracle of Wall Street. We'll revisit his bold 2026 market outlook, explore what's changed through the first half of the year, and uncover the opportunities that may lie ahead. If you're looking for perspective instead of panic, this conversation is one you won't want to miss. I'm Larry Sprung, your host for the Mitlin Money Mindset and founder and wealth advisor of Mitlin Financial. Let's dive into the show. Well, I am super excited to have Ryan Detrick back on the show, Chief Market Strategist at Carson Group and newly minted CNBC contributor. Welcome to the show, Ryan.
Well, Larry, thank you for having me back. It's an honor. I know we did it. Was it start of the year last time we did this, I guess?
We did. Yeah. Right after you guys released your 2026 market outlook. Wow. And we're going to try to make this a quarterly thing to address interesting topics and things that are taking place each quarter. So thanks for coming back.
No, it's an honor to do this. It feels like yesterday. It wasn't yesterday. You know, I didn't realize this. This is why LinkedIn saves you. I'm like hitting my 4-year anniversary at Carson.
That's right.
Yeah. So I think it's the 12th, technically, July 12th. But so 4 years, and it's been a heck of a ride, and the market's going up. The economy's hanging in there. We're going to talk about why we don't think it's over yet. So I'm looking forward to it.
Yeah. Well, listen, before we dive in there, it is your 4th year, anniversary right around the corner here with the Carson Group. But for those who may not know who you are, can you give them a high level overview of who you are and how you got here?
Grew up in Springfield, Ohio, southwestern Ohio, standard, kind of growing up. Went to Xavier University in Cincinnati, Ohio in the late 90s. I got the bug, the stock market bug. I didn't know what I wanted to do. I like numbers and math. Thought I'd be an accountant. Oh, my goodness, I hate accounting. But I like the numbers part of it. And then I got the bug. And I've pretty much woken up every day for the last 27 years looking at the stock market. And It's an honor. So I early in my career, I worked in research, like research newsletters, research places. So that's why I have my analytical kind of background that, I'm kind of known for and we'll talk about here. Then I said, I want to work with clients. And I'm really glad I've kind of done this transition, if you will. Work with a guy named Bert White. He's our CEO here at Carson. He hired me once. He's hired me twice now. So I don't know what this says about Bert, but he hired me at LPL Financial. Worked with Bert for a long time. Hit my 7-year itch there, and I was ready for something new. And now being at Carson's truly amazing. And then specifically what I do at Carson quickly, Chief Market Strategist. I say I'm kind of a face of our 15-person investor research team. There's over $60 billion total all of Carson. Our team manages over $8 billion of that, but we probably have influence over many, many more billions because people listen to kind of what we have to say out there. It's an honor. I say a research team does 2 things. We create content and we manage money. And there's a lot in the middle, but those are the 2 things we do. I live more, I'd say 75% on the content creation side. But I work with really smart people like Sona Varghese and Barry Gilbert on our team. I know, Larry, and other people know Grant Engelbart as well. And we manage money, right? And that's a really important thing that we do. So last comment on this, what I think makes me a little different, or really Carson in general, if people listen to Facts versus Feelings, the podcast that Sona and I do, and hear me on TV or wherever it is, I'm talking about the market, maybe a playful thing like, July's been higher the last 11 years in a row, whatever that might be. But I'm talking about how we manage real money, right? We're not just pontificating. We're talking about how we're not giving it away. We're not going to say, we just did a trade in our models for our advisors. We're not going to say that, but we're implying it. We're thinking about it when we communicate. I think that's what makes us a lot different is we do those 2 things. There's nothing harder than managing money, and there's nothing harder than making content that's creative and right about the market. But it's also an honor and a true joy to do that every day with some of my best friends and work at a company that truly empowers us to do that. And it's just a blast. And again, it helps when the market's going up, fortunately, but let's not complain. So there we go.
And I would add one thing. You do it in a very easily digestible way for people to understand and in a fun way. So we appreciate that. Before we dive into the market outlook, that we talked about at the beginning of the year for 2026 and where we see things now, now that we're hitting the middle of the year, I wanted to talk about something that was, just a few moments ago, not too long ago, and that was SpaceX. It went public, and it was something that it was an IPO that has, we haven't seen IPOs talked about so heavily until recently. Why was this IPO so talked about?
Yeah, that's a good question there. So I've been here for 4 years, as we just said. I don't think I've ever had more questions about one specific thing than the SpaceX IPO. It was, can I get into it? What do you think about it? Those are the two questions. It struck a nerve, not a nerve, but it struck something with a lot of people. And there's a lot of reasons. I mean, Elon Musk is quite, he's incredible, right? All the stuff he's done. He's kind of polarizing a little bit. So Elon's out there. You've got this $1 trillion company that's coming. You're going to send rockets in this outer space. You're going to send people to Mars. What does his company really do? A lot of people know, but a lot of people don't know because it does a lot of stuff. I think they're classifying it kind of as an industrial, but it really does a lot of different things. I mean, I fly on airplanes that have Starlink. I'll tell you, it's incredible. It's like, oh, that's SpaceX. Oh, that's SpaceX. So they do some of that too. So it's just incredible from that point of view. And the other thing, we haven't had a lot of big IPOs. Listen, it is what it is. A lot of companies that maybe thought they'd go public, 10 years ago, 5 years ago, have kind of just said, I kind of like the private markets. Maybe we're just going to stay here. Now, maybe that's changing a little bit. We have Anthropic and some other big IPOs that are set to come out likely later this year. But there was just this incredible demand, excitement, all about the company. And then, of course, what happened? The IPO, again, not a recommendation, probably going to say that. The stock went up a lot right after the IPO. Now it's got to come back down. Now it's like, okay, now we've kind of calmed down about all that hoopla. But I think it's one last comment here. The fact that the IPO came and went, everything was good, no major issues, no major hiccups, I think was a good thing for the market, for confidence. The investment bankers, everybody kind of did their job that they were supposed to do. What the stock does from here, listen, that's not up to me, that's not up to you, that's up to the market. But in terms of getting it to the market and to the people, it seems like everything went off without a hitch. And like we said, Larry, there's some other big IPOs coming probably sooner than later. We'll see.
Yeah. Well, let's talk about something you just said, because you said you got a lot of questions about, getting into the IPO, which we certainly did too, even from the families we serve. And I want to kind of dispel, I don't know if it's a fact or a feeling or a myth, whatever, but, when it came down to it, how much of an IPO, and it doesn't have to necessarily be, SpaceX, but just generally speaking, how much of an IPO is really available to the public versus institutions typically?
Ooh, boy, that's a good one. I know this one was much more accessible to retail. They gave it to certain brokers and certain places, but usually not a lot. I mean, I think the IPO price is a 135, and I think it opened up like 20 points above that. So right away, you're down 20 points if you if you wanted to buy it there. So it's not as much, but I think I'll take this a little bit different angle. When we look at IPOs historically, there's a guy named Dr. Jay Ritter down at University of Florida, call him Dr. IPO. He's got this big IPO database. The reality is like the first day of an IPO, he looked at like 3,500 IPOs going back like 30 years. Larry, the first day, stock's up like 20% on average, right? 3 years later, underperforms the market. There have been some huge IPOs the last 5 years, okay? Not just SpaceX. There have been some big ones. The majority of them within their first year were down like 30 to 40% peak to trough at some point. I'm not saying SpaceX is going to do that. Right. I'm just saying, there's a lot of excitement, but more often than not,
more sizzle than steak.
You don't have to buy. You don't have to buy that IPO. Maybe they're a great company. I mean, SpaceX is a great company, but the valuations are stretched. I'm not a valuations guy, but the valuations are stretched. Now it's come back a little bit. Maybe it comes back a little more. So you can wait a little bit. History tells us on just about every. I mean, listen, Amazon was an incredible IPO that came out. It came out real fast. Then the stock goes down 86% during the tech bubble and all that stuff, and then obviously it's come back 10-fold or 20-fold or 50-fold, whatever that is. So just things to think about with more big IPOs coming out. And the other way is, and this is kind of boring, everyone, but it's true. You have some of these big ETFs, they're going to be in there. I mean, I know SpaceX just added to the NASDAQ 100, I think, right? Yeah. So it's like you can potentially benefit. And the other thing, listen, people say, how do I benefit from SpaceX? Listen, all these companies own each other. They're all connected one way or another. They own some of this, own some of that. A lot of these companies that were going higher were doing very well because they own potentially some SpaceX. Like if you own some Tesla, well, Tesla owns SpaceX. Right? All this stuff is to a degree connected. So that's other ways to think about it. But to put a cherry on top, IPOs just don't take off and go straight up forever. They're going to have a rough period. History tells us that first year can be choppy. So SpaceX is having that now like it is. I'm not shocked. We'll put it there.
Mm-hmm. Yeah, me neither. So thank you for sharing that. Yeah. And, I want to talk about something we added that we talked about at the beginning that was added since the last time. You were recently named a CNBC contributor, right? What does that mean? What will you be doing for CNBC?
Yeah, thanks for that. So I've been doing a little more about history with Ryan. I guess we can call this history with Ryan. My very first CNBC hit ever was like the summer of either 2004 or 2005. I don't remember exactly, Larry, but it was then. And I went downtown Cincinnati, went to a studio. I can't find the clip anymore, but I mean, I'm sitting like this. I'm so nervous. Now I'm too relaxed, I think. And I was on with Bill Griffith, might name ring a bell a lot of people. Bill Griffith, CNBC, old school guy, and a guy named Reggie Jackson. Yes, that Reggie Jackson, Mr. October. There was a Traders magazine. We bought a spot. So I was on. Unfortunately, I talked like one time, and Reggie Jackson jumped in and kept talking. I was like, thank God, let him talk. I don't need to. So I survived it and did it. So I've been doing TV for over 20 years. I've got lots of connections, obviously leveraging social media or podcasts, Carson, all the stuff that, I've done over my career. And I have a friend named Jay Woods, and Jay is a CNBC contributor also. He became a contributor like a year or so ago. I said, hey, Jay, I've been thinking about becoming a contributor because the rule with CNBC, if you're not a contributor, Larry, you can only go on once a week. So if I'd go on Monday on whatever, morning Squawk Box, if closing bell said Friday, Ryan, can you come on? I said, I can't because I was on Monday. That's just their rule. And I was like, man, I used to go on Fox a lot, used to go on Bloomberg a lot. I stopped going on those as much, not because I wanted to, just kind of, I think I was branded a CNBC guy, which is fine. So I didn't do those other ones as much. I said, man, I should just go on CNBC more. So reach out to Jay, my buddy Jay, connected me with some people, and just started that. And I believe when I was named a contributor a couple months ago, there's like 74 contributors, only 74. So now I am, but now I can only go on CNBC. I cannot go on Fox anymore. I cannot go on Bloomberg. So I've got friends at all of those. So that's too bad. But you know what? I'm happy with it. I think it's a great move for Carson, for myself, to get our brand out there, continue. So now I'm going on CNBC, 2-3 times a week. I'll be in New York soon. I'm going to go on 2 days in a row, and I can go on as much as they want me, which is great. And I still get to do it. And CNBC is awesome. They've been so great to me. It's just neat when you look at the 70, I think they might have dropped a couple, but let's just call it 72 contributors now. It's some big names. I mean, I pinch myself. I'm on that list, and it's like a little club, and it's a real honor to get to do that and represent Carson along with CNBC.
Yeah, what a meaningful place to be where, you're in a profession that's, rather large and sought after, and you're one of 70 some odd contributors. I think that's a testament to, what you bring to the table, and thank you for that. You've had a lot of accolades this year, adding the CNBC contributor to your situation. And you were also recently nominated for a Wealthy for your podcast, Facts vs. Feelings. And it's the podcast you host with Sonu Varghese. What does this mean to you? And, I got to say, we're going to have a little friendly competition because my YouTube channel, Larry Sprung, is up against you guys. So we'll see how that works out. But what does it mean to have the podcast now nominated for a Wealthy?
Yeah, it's another example of just kind of like, I would do this stuff if I didn't get paid. Now, let's be clear. I want to get paid. But like what I get to do all day, like hang out with you and talk, and hang out with Sonu and talk, and manage money, and write content, write blogs, write outlooks, do YouTube videos, travel the country, present for advisors, present for clients, go to New York, run around New York, do media stuff. Like, it's a blast. And then the stuff I get to do, like Sonu's one of my best friends, right? I get to hang out with him all the time. Literally, time you and I are done, he and I are going to record our podcast. And I haven't talked to Sonu in like 2 days. We talk, like we're buddy, like we talk, we have fun recording along with markets. So I have to pinch myself. And then I'm like, wait a minute. And then it's like people actually listen to it, which we know. I mean, it's been growing. It's been great. But it's really an honor, because then it's like you get these honors, and thank you. I know, Denise and you kind of, helped push some of this stuff. So thank you for getting that out there and getting it. I know you're up for some awards, which is amazing. Totally. I got some other friends in the industry that I'm like, I know them. It's like it'll be a who's who of people. But hopefully everyone has a blast. It was September 10th, right? September 10th, I think, is when we get to go to New York City and do all that. And I can't wait. It'll be an honor.
Yeah. And when we do our next market update together, we'll share with everybody how we fared. We'll see how it goes. Let's pause for a moment. What actually brings you joy? It's something most people never think about, yet it shapes how your life unfolds. You're busy. You make responsible choices. You even plan ahead. But have you slowed down long enough to ask if what you're building supports a life you enjoy living? That's the reason I built my YouTube channel, to help you bring more joy to your money journey. Sure, we'll talk about all the essentials, but my real goal is to help you connect your finances with what brings you joy, because money is the tool that funds the moments that matter. If you want to explore that connection more deeply, visit my YouTube channel at Larry Sprung. So listen, I want to shift over to the market outlook for the rest of the year, right? Or at least for the foreseeable future, and then we'll do another update in Q3. But back in February, you and I covered your 2026 market outlook, which you called 2026 riding the wave.
Yeah.
You know, I want to check in. You know, how are we doing against those original forecasts that you presented back in January?
Well, I think pretty good, Larry, is a quick summary. Now, you know, we said at the start of this year, the S&P 500 would gain between 12 and 15% on the year. We said to be overweight equities. One of the themes that we also had was a broadening out, because if people probably remember this, in 2023-24, the Mag 7, the large tech names, they did very, very well. If you didn't have an overweight to those areas, you probably didn't do quite as well. Well, we said the broadening out thing. The first half of this year, small caps are up 20%, mid caps are up 15%. Most of the globe was up low teens. The S&P 500 is up right around 10%. So it's been a really, really good year, the first half of this year. Now, listen, it wasn't easy though, right? We had a 9% peak to trough correction back in February and March around the war, right? Oil literally doubled virtually overnight. That is a 6 sigma event, 6 standard deviation event. What does that mean? Larry, that's supposed to happen once every 4.1 million years. It happened a couple months ago. That's the funny thing about markets. So it wasn't easy. It was rocky. There were scares. But the reality, every year is going to have that. Midterm years, like we are right now, tend to be kind of volatile, tend to be choppy. But again, we laid out why we didn't see a recession, why we saw words we've used all year: inflationary growth environment. Start of this year, Sonu said we might have 3 to 3.5% inflation this year. We saw signs inflation was kind of broadening out. Not that's the end of the world, because again, we thought the economy is still growing in that environment. People hear inflation, they think, oh my God, it's all going to fall apart. That's not been the case at all. So overall, this has been a solid year for us, the way we manage money, some of the big calls we've had. Last comment on this, in late March, when the S&P 500 was down 5% for the year, and Larry, you look up and you're like, wow, 15%. That's pretty darn far away.
Yeah.
We doubled down. We had a lot of, believe me, you have some come to Jesus moments when you manage money and you realize market's doing what it was doing back in late March. But we said there's reasons that we're going to come back. And fortunately, we had literally the best second quarter in the history of all midterm years for the S&P 500, up almost 15%. Now we're rallying. We think the summer rally is going to continue. We can talk more about the second half of the year here next. But to put the picture on where we've been, I would say what our team has done, what our team has said, how we've managed money. I'd put it up against everyone. Believe me, we've made mistakes. Believe me, there's areas I wish we would have done a little better. But on the whole, I would think what our 15-person research team has done is just as good as any bank that's got 2,000 people.
Yeah. I mean, back in March when we saw that pullback and you guys doubled down and continued on with the outlook that you guys presented, were other firms not doing that? Were they pulling back? Well, what were they doing?
Yeah, they a lot were cutting their targets. You watched strategists on TV. A lot of the bullish strategists were all of a sudden quite bearish, talking about their S&P 500 target was here. Now we're cutting it to here. So there was a lot of that. And the interesting thing about it, if you look at like the 5 other years under President Trump, March is terrible. Now listen, you can maybe it's random, maybe it's not, but early weakness under President Trump has been quite normal. He sometimes does some big things that come out early. Obviously, Liberation Day happened the year before, near bear market then. Obviously, COVID, that's a little different. We understand it, but still you had a market low in the late March, early April timeframe. So once again, you had history to repeat itself, but often rhymes, Mark Twain. We were down 5%. Ballpark in the first quarter. I don't think most people remember that. I don't think most people remember we were down 5% in the first quarter. Then we gained 15% the next quarter and ballpark up 10%. Just to put a little context around this, Larry, when you're down one quarter and then up 10% the next quarter. The next quarter, so that would be the third quarter we're in now, has been higher 16 out of 17 times.
Wow.
2 quarters later, you're higher 15 out of 17 times. There's some very, very big returns. Momentum is real. And we called our outlook 6 months ago, riding the wave. Well, I think the first time I'm going to announce it's right here with you right now. We are calling our mid-year outlook still riding the wave. We can get more into that, but we still think there's a lot of waves and a reason to be optimistic the second half of this year.
Yeah, so it sounds like you're thinking that the 16 out of 17 times, the 15 out of 17 after coming off of that weak first quarter, strong second quarter, sounds like you foresee that that's going to continue, and you see that going for the remainder of the year. Where do you see things going from here?
Yeah, we do. So again, at the start of the year, we said between 12 and 15% S&P 500 return. We're going to up that a little bit. We think it's now, we are. Our target now is between 15 and 18% on the S&P 500. So we've always been overweight equities, always pretty bullish. Those are positives. We still think this market's alive and well. Bull market's alive and well. One thing that's really fascinating about this year, and there's a lot, trust me, the earnings growth. At the start of the year, S&P 500 earnings were expected to be up in this year, in 2026, about 14% year over year. Okay, that's pretty good. What's that mean? Well, now, Larry, halfway through the year, it's expected to be up like 24%. That's incredible. Earnings continue to go higher. Profit margins continue to go higher. Call these the dual tailwinds to a bull market. For 3 years now, in our outlooks and mid-year outlooks, every 6 months we do an outlook. Start of the year, the big one. Mid-year outlook, middle of the year. I write the same section. It's kind of like a joke almost to myself and people that really know this. I'm going to let all the listeners know this. If you go look at what we write in this outlook that's coming out right now, there's going to be one called the dual tailwinds. And it's like talking about earnings and profit margins going higher. Been talking about these for 3 years now. When earnings are hitting record highs, continue to expand. When profit margins are hitting all-time highs, continue to expand. Those dual tailwinds make up for a lot of sins. Yes, the uncertainty out of Washington. Yes, the uncertainty with the Fed. Oh, inflation is a little bit hot. Did you look around the globe? Things aren't really that great. There are some strifes. There are some problems around the globe. But earnings make up for a lot of sins. And the good news, we still think this earnings backdrop being led by one last comment on this. One of our bigger calls the second half of this year, besides still being bullish, but listen, a lot of people are kind of bullish. We think the labor market is going to come back. All of last year, we averaged 10,000 jobs. We made 120,000 jobs all of last year. Right. That's not a good labor market. No. We've been averaging 110,000 jobs created the last 3 months. We think the second half of this year, this is the incredible work that Son of Our Geese, our chief macro strategist, does, that he's been seeing signs the labor market's starting to improve. And he's been saying this for a couple months now. So if the labor market can continue to improve, let's say about average 100,000 jobs the rest of this year, which we think it could, that's pretty solid. That is going to be a positive, because what's really led our economy the first half of this year, it is AI, it is CapEx spending, it is all the infrastructure spending, all the stuff because of AI. And there's nothing wrong with that, but we really want to see the consumer coming back. And the consumer is okay. I would just put the consumer at okay. Kind of cracking, but maybe not. It's kind of, you go either way. If that labor market comes back, Larry, like we think it can, that's going to be a big positive for the economy on the whole the second half of the year, and still riding the wave of the AI and AI CapEx spending and AI rollouts and AI earnings and all that stuff that we don't think is slowing down anytime soon. My friend Dan Ives, Dan, he says we're still in the third or fourth inning of the AI rollout. Listen, I don't know, but I know Dan's still kind of bullish. We manage money. We're slightly overweight technology still. We're slightly overweight industrials. We're slightly overweight healthcare. We see those areas as areas that continue to lead. Even small caps. We've got some small cap exposure as well, kind of a barbell approach. Large caps over here, small caps over here. You don't have to be cute and just pick not a recommendation, but let's own NVIDIA, let's own this. Right. You can own baskets of these things and look around the globe like Singapore, okay? The Singapore stock market just this year broke out of levels it was traded at 2007. To think that this bull market is about to end when I see other parts of the globe breaking out, the U.S. has done amazing, okay? It's been great. If you've invested in the U.S., like everyone on this call probably has, you've done well, but we still see opportunity around the globe as well. And those are net positives for investors, I think.
Yeah, 100%. And we're going to have a link out to the market outlook. It's going to be found at mitlin.us/2026 outlook. We'll be updating that with still riding the wave. So you'll be able to get that and read that. You talked about a lot of positives there, right? Job market, earnings, profits, et cetera. What do you see as the biggest hurdle to the markets right now and for the remainder of the year?
Yes. So, the funny thing about midterm years, you do tend to have volatility and weakness ahead of the elections. That'd be in November. And the other funny thing about it is sometimes it happens out of the blue and you don't notice it. August, for whatever reason, Larry, has had some out of the blue events historically. So we're not, we're paid to worry. I said, we're paid to worry. Your clients and listeners, let Larry, let your financial advisor kind of do the worrying for you. But there might be something out of the blue. I mean, 2024, we had the yen carry trade unwind that first Sunday, right? The market was crashing. Japan was having its worst day since 87. Now it's like a footnote in history. Like, oh yeah, I remember that. We still gained 20% in 2024. There could be something out there that we don't even see. But to answer specifically the question, it's the Fed. The Fed to us is a big deal. We have new Fed leadership. Kevin Warsh just took over. Go look at your history books. Markets tend to test a new Fed chairperson. I looked at the last 10 Fed chairpersons. Within the first 6 months, the markets had like a 15% peak to trough correction. Now, that's somewhat skewed because of 87, when Alan Greenspan took over, had to crash soon after of 87. But the reality is markets can test a new Fed chairperson. And again, what it was a big theme we've had, one of the things Sonu's been talking about, we might even called facts versus feelings this a couple weeks ago, run it hot. We think the Fed's going to run it hot. Inflation is around 3%. Should the Fed hike here to put the brakes on it? Listen, maybe not. We don't think the Fed is going to hike. We think they're going to continue to run things hot, which should still be a positive for this year, maybe even into next year. Maybe eventually you have to pay the piper there, but maybe inflation comes back. I mean, oil literally is round trip from where it was trading before the war, doubled and come all the way back. So those are still positives overall. But I think Fed policy is something, a potential Fed mistake. If the Fed were to become extremely hawkish here, that totally could put the brakes on this bull market where we are. We don't think, again, that's not our case. That's not our base case. But that's why we own some bonds, why we own some other things in case we're wrong. We'll be okay with that. If you think about a 60-40 portfolio, 60% stocks, 40% bonds. That's kind of the old school way of thinking, by the way. We're probably about 69 to 68%, equities here with a decent amount of international exposure as well. It's not just about fixed income. Yes, we own some fixed income, but we own some hard assets, own some real assets, own some managed futures, own some gold. Something we've been saying for a while, this is that other 31 to 32% bucket, is diversify your diversifiers. It's the honest truth. Bonds haven't done as well. I mean, the last 5 years or so. They still do an okay job, but we think you have some diversification in that bucket over there makes sense as something we've been preaching. And even though we've been bullish equities and it's been a great run, with the money we run, we've actually done a little bit better in our fixed income buckets, in our other buckets, even though we're not known for that as much because the way we've positioned ourselves for that bucket out there. So again, I don't even know what you asked me. I'm on a little rant now. But the reality is this is still a bull market. Stay overweight equities, diversify your diversifiers. There's going to be bump. The worries. There's probably going to be some bumps and bruises along the way in a midterm year. That's perfectly normal. So don't get too worked up. Plans are useless. Planning is everything. President Eisenhower planned for an August, September, October. I don't know when. I wish I did. Trust me. Surprise where the market maybe pulls back 10% or so. It happens. It's happened earlier this year. It'll happen again, but we're going to get through it because earnings and the economy are still solid.
Yeah, I mean, you talked a lot about the Fed impacting things, right? And we're also talking about midterms. Is there any evidence when those two things collide that causes markets to go in one direction over another, or not really?
Not really. I guess we've only had, I think, 16 Fed chairpersons, and I mean, I'm not even sure. Honestly, it's a great question. You got me spinning a little bit here. But I will say, from purely a midterm point of view, midterm years see a 17.5% peak to trough correction at some point during the year. That's the largest out of the 4-year presidential cycle. Listen, nobody knows what it's going to be. Here's what the listeners need to really know, though. Off those midterm year lows, Larry, 1 year later, and again, no one knows what the midterm year lows are. That's the catch. It very well might have been late March, though, that 9.1%, or that might be the largest we see all year. The S&P 500 is higher a year later every single time, and up over 32% on average. So sometimes no pain, no gain. Something. But one more thing on midterm years. Everyone was talking about the start of the year. Midterm years usually aren't that great. Listen, 2022, that was a terrible year for investors. Yeah. 2018, not a very good year for investors. Now, some of the other ones were okay, but recency bias is real. But under a second term president, so let's call it the president's 6th year, and I get it, what everybody's thinking. This was not President Trump's 6th year in a row. I understand. I put an asterisk next to it, whatever you want to do. The last 5 presidents, Larry, going back like 50 years, those years every time were higher in a midterm year. And that's something we were talking about. And that's not about red, not about blue, maybe because you know what you're going to get, whether you like them or you don't, you know what you're going to get. Markets are all about kind of what's priced in, what's not priced in, what uncertainties out there. Yes, President Trump, you could argue, is a little more volatile, a little more uncertainty with what he does, but the market knows that. And the market also knows earnings are still strong. CapEx is still strong. Consumer spending is still strong. I mean, last thing on this, we just had data recently, the last 2 months, consumption's running at an annualized rate of 6.9%. People are still spending. I mean, that's still a positive. If that labor market comes back like we think it can, it's just one more positive thing out there.
Yeah. So it sounds like we're expecting to still ride the wave for the remainder of the year. And, the expectation is that there could be some volatile spots along the way, possibly because of the Fed, possibly because of midterms, but volatility is the toll we pay, right, to be investors. So,
that's right.
Check out the market outlook at Mitlin.us/2026 outlook, and you'll be able to see, it in detail. And Ryan, I really appreciate you coming on and sharing this. And as you know, we're all about joy on the Mitlin Money Mindset. And we end the show by asking every one of our guests, including you, the same final question. And that is, what did you do today that brought you joy and put you in the right mindset for success?
Yeah. So before this, we were working on some things for my daughter. She's going to Penn State University, I guess, in 6 weeks, 7 weeks.
Yeah,
that's
too long.
Coming fast. That's coming fast. Anyway, so it's kind of neat to work on some things, and we're talking about like her dorm and different things, and it's kind of. It's exciting. I mean, you've gone through it, obviously, with multiple children, right? This is my first child. We're kind of sending off, leaving the nest or so, but she's ready. I'm excited for her to do this. And as we kind of inch closer, then she and I are going to come to New York City very, very soon. Maybe by the time people hear this, I've already been there, but going to hang out in New York. I'll run around, do TV and media stuff. And then she and I are going to have a nice dinner, probably going to go see a show together and just kind of hang out. So I am looking forward to that as well.
Amazing. Well, great stuff. Ryan, if people want to learn more about you, follow you, we're going to have all your information in the show notes, but what's the easiest and the best way for them to do that?
Well, yeah, thank you for that, Larry. The two easiest, I guess, Facts versus Feelings, or if you get your favorite podcast, you can just type that in. It'll pop up pretty quickly. And I'm pretty active on social media, specifically X or Twitter, whatever we want to call it, at Ryan Detrick. I do a lot on there. Obviously, I'm on LinkedIn. And then we have a company website, carsongroup.com/research. We do, maybe even two blogs a day anymore. I write some, Sonu, but the entire investor research team writes different things, all of our specialties, what's going on. So to see what the whole team is up to, you can go to that website as well.
Thank you so much, Ryan. We look forward to connecting with you again in October to see where we are at the end of Q3, moving into the end of the year. We'll see how some of these things that we talked about play out and set things up for 2027. So thanks for taking out time and joining us today, and enjoy the rest of your day.
Well, Larry, like I said, it's always an honor. And I said, if it doesn't work, we just blame Sonu. That's kind of what I do. But I look forward to that. Thank you for everything you do, for the incredible community you have, the way you help your clients. It's an honor to work with you every single day. And I'm sure I'll talk to you before October.
Yeah,
but I look forward to talking with you on this interview format in October. So thank you.
Ryan, thank you once again for sharing your perspective, optimism, and your incredible ability to bring clarity to an ever-changing market. Today's conversation reminds us that successful investing isn't about predicting every twist and turn. It's about staying grounded, focused, and committed to a long-term vision. We appreciate you helping our listeners navigate the journey with greater confidence, perspective, and joy. It's always a pleasure having you on the Mitlin Money Mindset. Ryan Detrick and everything he's up to can be found across most social media platforms. All the contact information needed to find them can be found in the show notes. And be sure to visit Mitlin.us/2026 outlook for the still riding the wave mid-year outlook.